From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Wednesday, June 15th. Here are the top market stories that we're following for you at this hour. Hurry up and wait. The ECB's emergency meeting underwhelms by going long on words, short on action. The bank now says it will accelerate a new tool to fight against fragmentation. And the Fed plays catch up. Markets and economists increasingly expect a 75 basis point hike today as central banks fight to retain credibility. And Bitcoin teeters on the edge. Price bounces off of the 20,000 mark as crypto investors struggle to stay afloat. We're going to speak to Michael Schonenstein, Grayscale Investments CIO. From New York, I'm Alix Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Whatever you think the ECB should have said, they did move bond yields significantly to the downside over in Europe. And now I feel like we have to wait and see if it can sustain that come to when we get the Fed announcement.
Yeah, in some ways, we anticipated a lot out of the ECB. We didn't get it. But as you say, the market reaction has priced in something. And we've certainly seen spreads compressing, bunds to BTPs. As you say, though, I think we'll probably now move on to the main event, which is the Federal Reserve a little bit later on. Alix, it feels like 75 basis points is now priced. What do the dots say about this story going forward? I think that's going to be absolutely fascinating. But what we have certainly seen over the last few days is a significant repricing in the mortgage market. Mortgage rates have been going higher. We're getting some data out right now. The National Association of Home Builders index comes through exactly as anticipated at 67. Remember, this is a gauge that goes 0 to 100. Anything north of 50 is positive. But we are seeing a slowing, Alix. Yeah. 69 was the last number. 67 is this number. This could be one of those moments where Alix gets to talk about where on that chart she took out her mortgage.
Yep, it would be right at that low that you saw in the beginning of 2021, right there. It just shows how fast it really has re-rated. But I think what it is interesting is this is what the Fed does want to see, right? I mean, they want to see the housing market cool off the same way that they want to see U.S. retail sales slow a little bit. Are we starting to see the first signs of that demand destruction that we need to see to get inflation under control? I guess it just raises the question of how fast that can re-rate to the downside.
So let's talk about our question of the day, because we pondered this. We ruminated on exactly which question we should be asking today. And the problem was we couldn't come up with a convincing answer. So then we thought about this. Which mistakes or which mistake are central banks making right now? And there's a number of different ways of looking at this. Are they behind the curve? Should they be doing more? Should they be raising rates faster? Are they risking a recession? If they raise rates now, is there going to be a recession in the near future that they're going to have to reverse? There's all kinds of things going on here. But I think the problem, Alix, is very different on each side of the Atlantic. The ECB feels like it's got one problem. The Bank of England feels like it's got another problem. Then the Fed has got a completely different problem. So maybe they're all making different mistakes. Well, let's ask that question to Michael McKee, Bloomberg's international economics and policy correspondent. We're also joined in New York by Christina Kino in New York. Mike, I'm going to ask you, though, the first response on that one. Get the first response on that one. Which mistake do you think central banks are making right now?
Well, I have to agree with you, Guy. The situation is different on both sides of the Atlantic. It is very hard to say what a mistake is, except in hindsight. What may be happening here is the U.S. economy is already slowing. You and Alix were talking about home sales starting to slow. Auto sales have slowed, and retail sales came in negative in the past month, even though inflation was up. So is the Fed tightening into a slowing economy and speeding up that pace of tightening, given the fact that we see a long and variable lag, as they say, with the impact of interest rates? Could we be seeing those impacts start to hit at a time when the economy has already really slowed? On the European side, the question is, are they going too fast for the kind of monetary union they have constructed, where everybody has a different economy? This gets to the question of, did they make a mistake last week by not talking about fragmentation, and did they come back and do something acceptable about it today? Doesn't look like the markets are buying it. But there are a lot of people who say we've seen spreads go up, but they're not up anything like they were back in 2011. So it's hard to say they have made a mistake yet, but there are possibilities out there.
Sure, and the market definitely re-rated, but we do have to wonder, like, why call an emergency meeting and not actually announce anything, I think is puzzling many people. Christine, I guess take the ECB side. I know you're here in New York, but you cover macro over in London. From the ECB side, like, what's that mistake? What's the biggest mistake that central banks are making?
Well, Alex, I think from the ECB's perspective especially, but really this applies to all central banks, is really underestimating markets' ability to overreact to what central banks are doing. I think the reaction in markets that we're seeing right now to the ECB is very much part and parcel of the initial reaction they had when Christine Lagarde was asked the question of fragmentation at the ECB press conference last week. And clearly markets were not satisfied by that answer. They reacted accordingly. And now we see the ECB almost trying to catch up a little bit with that reaction in the markets and finally acknowledging that, yes, they do have to do something very specific addressing this fragmentation risk that perhaps they may have underestimated at the time of the ECB press conference.
Christine, do you think markets are reading too much into central banks? Do you think central banks are reading too much into markets? To kind of pick up on your point, I found it fascinating that we got the Wall Street Journal article earlier on this week, which basically took us towards the repricing for 75. The ECB seems desperate to communicate with the market that it's got this one. Is there a danger here that the mistake the central banks are making is to try and fine-tune things too much, trying to micromanage things too much, trying to over-communicate too much? Is that the mistake they're making? Because at the moment, it's so difficult. The data is all over the place. The macro environment is incredibly difficult. Trying to fine-tune this story, very difficult, and the potential, therefore, for mistakes, huge.
Absolutely, Guy. I mean, I think, policy making is a very kind of different tool, right? But when it comes to markets, it's kind of this blunt force that really reacts massively and really kind of, it's unstoppable in one direction if it really wants to go there. I mean, this is exactly what we saw, for instance, in Fed pricing, in the Fed repricing, I should say, over the last couple of days. I mean, even before that Wall Street Journal article that we were referencing, we already saw 75 basis points pricing for July for the Fed after that blowout CPI figure on Friday. And that, of course, really just accelerated after we saw that article. But, again, it's markets kind of overreacting, as you say, but there's really only one way that they usually go. It's kind of overshoot that reaction once they get some kind of catalyst. Think about the consequences or perhaps fine-tuning that reaction a little bit later. And I think this is where central banks need to understand it's a market's tendency to kind of hit the sell or buy button first, depending on what they're selling or buying, and then think about it later.
So, Mike, I think that also then raises the question going into the Fed meeting in terms of the summary of economic projections and the dot plot, because as traders are kind of bringing forward their rate hikes to bigger and faster rate hikes, then you have economists worrying about a recession in 2024. And I wonder then how we read the dot plot, considering that they had to deliver their projections and stuff right before that inflation number.
Well, there's no reason they couldn't have adjusted their forecasts after the inflation number. I mean, I think if it significantly moved the dial on one of their models, they would come into the meeting and say, look, we can't put out an old number like that. The problem with the dot plot and the SEP is that they quickly become outdated. And we've seen that happen since the March meeting, the last time they did it. Markets react minute to minute to developments, and the Fed puts out a new forecast once every 3 months. So it's kind of hard for them to keep up. And then the markets react to the fact that the Fed forecast is old. So it's a kind of a no-win situation. What we will get today is markets will look at what the Fed's saying and see how it compares with what they think is going to happen. And for a couple of days, we'll be fine. But then we'll get some more data next week, and people will look around and say, is the Fed behind the curve, or maybe are they ahead of the curve? One interesting thing that I have heard over the last couple of days is that perhaps the Fed is looking at this as, if we are tightening into a slowing economy, and there's some preliminary signs of that, then maybe we front load and we move up the number of moves we're going to make and make them earlier, so that by the time they hit, we're not still raising rates by 50 or 75 basis points because we're looking at backward-looking data. So that's also a possibility.
One that I'm sure President Biden is thrilled about with the midterms coming up in November. Guys, thanks a lot. I really appreciate it. Bloomberg's Michael McKee and Christina Aquino. And tune in to Bloomberg special coverage, The Fed Decides. That begins at 1:30 p.m. New York time. Now, coming up on this program, more of our question of the day. What mistake are central banks actually making right now? We'll discuss with Nathan Sheets, Citi Research Global Chief Economist, coming up next. This is Bloomberg.
I think what's clear is central bankers need to catch up to their economies. They've been behind the curves. They've acknowledged this, and they need to start to get interest rates above inflation effectively, or at least prospective inflation expectations.
That was former Bank of England Governor Mark Carney. So let's get back to our question of the day here. Which mistake is central banks making? Joining us now, Nathan Sheets, Citi Research Global Chief Economist, joins us now. Nathan, there's a lot to choose from potentially. Staying with the Fed for a moment, what's the biggest mistake?
I think where the Fed is that it made a monumental mistake, a generational mistake last year, and let inflation surge upward. And now it's having to move vigorously to address that. And as it moves vigorously, there are consequences to the economic outlook, to growth, and to market performance. But in some sense, I think the Fed's path is predetermined by previous events, and now they really don't have many degrees of freedom. They've got to be aggressive.
Okay, let's talk about that, Nathan. If you're going to be ahead of the curve or at the curve, where would rates need to be right now on an inflation-adjusted basis?
This is a very tough question, and now I can say they need to be a lot higher than they are at the moment, and sure. I would further say they need to be a lot higher than they're going to be at the end of this Fed meeting. Whether that means a Fed funds rate of around 125 or they go 75 and it's around 150. We know that it's likely going to need to be well above neutral at 2.5. But is that, mid threes like their dots are likely to show? Or is it a much larger number? I mean, what's scary, and I think Mark Carney just alluded to it, how did Paul Volcker extinguish inflation from the U.S. economy? He hiked the Fed funds rate until it was above the rate of inflation. Mm-hmm. And that is a very scary proposition. And
right.
I don't think they're going to need to go there, but that's even on the table.
Yeah, but, Nathan, let's pretend for a second that's like, what, 8.5 versus like a neutral rate of 2 3/4 or 3 or 3 1/4. That's a huge band with which the Fed has to play with. And I'm wondering how much they wind up hiking to crush the economy. I mean, is that necessarily the goal? Crush the economy and get inflation under control, and what that actually looks like?
I think it's a practical matter consistent with what I said. Fed doesn't know where it needs to land. So what it's going to do is move very quickly to 2.5, assuming that's neutral, but even neutral in this environment is probably uncertain, right? And then move more gradually. But I think Jay Powell and his colleagues are really uncertain as to what the endpoint of this process is. Hopefully, we'll see inflation start to reverse on some base effects, if nothing else, and we'll be looking at handles, between 4 and 5 rather than 8.5.
Nathan, the Fed, the ECB, the Bank of England, to a certain extent, trying to micromanage the market reaction here, trying to micromanage market expectations as to where rates are going. We saw that with the Wall Street Journal piece earlier on this week. We've seen it today with the ECB with an emergency meeting that maybe didn't need to be an emergency, and maybe it created an emergency when there wasn't a need for one. But nevertheless, there seems to be this desire to micromanage. Is that a mistake?
central banks are in this exquisite challenge with their communication and how it's perceived by markets. And this has been with us for many years, that on the one hand, they don't want to suggest that what they do is determined by the market. But by the same token, they really don't like to disappoint the markets. So how do you thread that needle? Well, you communicate. And Guy, as you suggest, maybe at times you even over communicate to the point of it seems like fine tuning. But I think that's what's going on here is they want to look like they're in control, but they also don't want to disappoint or really surprise unduly, because that could create volatility. And how do you thread that needle? You just talk a lot.
That's a great way of phrasing it. Thread the needle by saying a lot of words. Nathan, exactly. We've seen a lot of economists just for today upgrade to 75 basis points. The market seems to be expecting that kind of hike. You guys are still at 50, right? And I'm wondering why at 50? And do you think that, by tomorrow we'll be talking about 100 is the new 75?
I think we are in a world where how fast you move is very uncertain. And if it's 50 or it's 75, could the Fed then say, well, we want to get back to the territory of neutral in one step? Absolutely. In terms of 50 versus 75 at this meeting, I think they're debating it, and they're debating it vigorously as we speak. But based on the body language we're getting from the institution, my feeling is that the 75 is definitely on the table, and we stuck with the 50 because that's where we've been. But I don't think anybody would be surprised if it's 75 that's announced this afternoon.
Nathan, I woke up this morning anticipating largely to spend most of my day speaking about the Fed, maybe looking forward to the Bank of England, maybe thinking about the BOJ, but the ECB decided to step on that. We had an emergency meeting a little bit earlier on. I'm not entirely sure as to why, but the debate at the ECB feels like it's a different one. The debate seems to be, what is our priority? Is it fighting inflation or is it fighting fragmentation? Which do you think of those two wins out?
ECB is in even a tougher position than the Federal Reserve. As you're suggesting, they have to think about inflation, they have to think about growth, but they've got this very thorny issue with financial fragmentation. And it is very possible that financial fragmentation becomes the binding factor for them in this hiking cycle. I do think that if they get into that world of financial fragmentation, it's likely to create headwinds for economic activity more broadly than just in the peripheral economies, as we saw in 2011, 12, and 13. And I think it's likely to slow the economy and likely slow inflation. But that is a very, very messy process. And I'm hopeful, but given all the constraints, the bar is high, and there's a lot of challenge facing the ECB. But I'm hopeful they'll be able to figure out some kind of a tool that restores market confidence and addresses these challenges.
Well, it feels like in some ways the tool is if 10-year yield BTPs reach 4%, the ECB freaks out. I mean, did we learn anything about where the breaking point is? I appreciate they didn't announce anything today, but their urgency with which this meeting was drawn together.
Yeah, I think it gets back to the point that they felt like they needed to raise the flag in some way and say, we're paying attention, we're not out of touch, but they're also not quite ready to present that instrument that they're going to use, which is a little surprising. I mean, they've been talking about this for a while, that they need to send it to committees to debate it. Maybe that suggests that, 4 is a yellow light and there's some higher number they have in mind that's a red light. They may also be calibrating it by spread relative to boons, and, maybe a little over 200 is a yellow light, but maybe they're looking for 300. But eventually,
do you think, Nathan? Do you think Do you think they were worried that the Fed was going to do 75 or maybe even more than that today, and that global bond markets would react? Were they trying to get in front of the Fed today?
I think that's an excellent point. You know, the old saying is that the Fed is the central bank for the world. And as the Fed moves aggressively to fight inflation, I think that inevitably transmits and undulates through expectations in global financial markets. And people in other countries look at their central banks and say, what are you doing to fight inflation like the Federal Reserve is? I think it raises the bar. And trying in some sense to be plugged in and responsive, I think probably did enter the reaction function. It's hard to say it was just a coincidence that they called this meeting on the same day as the Fed meeting.
Yeah, in advance of the Fed meeting. Always a pleasure, Nathan. Thanks for jumping in. Great to see you. Nathan Sheets, Citi Research Global Chief Economist. Thank you, sir. This is Bloomberg.
The consumer is the heart of the economy, and the consumer is still strong. The consumer is still outspending. The consumer still is sitting on excess savings. The household balance sheets are strong. We just got the latest data from the Federal Reserve flow of funds. And yes, household assets dipped a bit in the first quarter, but very modestly.
That was Michelle Meyer of the MasterCard Economics Institute earlier on Bloomberg Surveillance. All right, we're an hour into U.S. trading session. Stocks up solidly, although we're still down like 13%, I should say, since the last Fed meeting. So it's been a pretty bumpy ride. Bloomberg's Abigail Doolittle is tracking some of those moves. So 2 up days. We'll see 2 p.m.
Yeah, well, a bumpy ride indeed, Alex, since that last Fed meeting. But right now, at least, we are looking at the first up day in 6 days. The S&P 500 right now up 1.3%. Its best day going back to June 2nd, so almost 2 weeks. The same deal for the tech-heavy NASDAQ, faring a little bit better. And that, of course, has to do with yields in on the day. So providing some relief for some U.S. stocks as investors think that an extreme move by the Fed, whether that's 50, 75, or 100, is already priced in. The stock 600 doing even better, up 1.9%, its best day in more than a month. And oil, that could be another small tailwind. We have some inflation pressure coming off there with oil down 0.6%. Yields, though, that is the story. Let's take a look at a 5-day board of yields. And this is not even that bad. Yesterday, this was really ridiculous. The 2-year yield yesterday up 70 basis points over 5 days. Right now, up 55 basis points over 1 week. This could be a 1-year board as it is. But again, we've had big consolidation in the same for 10-year yield. And of course, some of the European bond yields absolutely blew out, but they've come back in more recently. That 10-year Italian yield had been above 4%, now at 3.77. The German 10-year yield over the last 5 days up right now about 27 basis points at 1.62. So that's the inflationary picture there. Even so, it does seem that investors think that the Fed, whatever they do, is probably priced in. This is a look at some of the inflows for the SPY and the QQQs. And you can see after 2 brutal down weeks, we're looking at an up week relative to flow. So some optimism, again, ahead of the Fed. Speaking of optimism, we have the big banks up sharply. This is the yield curve steepens, even though yields are down. Take a look at Citigroup, up 3.1%. They, of course, talked about how their current quarter trading revenue up 25%. We see a nice lift for the other banks. What's so interesting here, Alex and Guy, is the fact that Citigroup is also talking about 2Q investment banking revenue being down 50 to 55%. So a real tell on the times. You have the volatility helping out the stock traders, but not so much for the deal makers.
All right, thanks, Abigail. I appreciate that. Let's get some breaking news for you. The oil inventory numbers have crossed. There's just one thing you need to know. Gasoline inventories fell 710,000 barrels. Gasoline inventories continue to be drawn. Refinery utilization actually dropping a little bit. And this is so important, Guy, because just today, President Biden sent a letter to 7 major U.S. oil refiners saying there's no question Vladimir Putin is principally responsible for the intense financial pain the American people and their families are bearing. But At a time of war, refinery profit margins well above normal being passed directly on to Americans are unacceptable. And therein lies the issue. Like, now we're going to see the administration go after oil companies and refiners. None of that is going to help them actually do more with the refineries that are actually still operating. Maybe push back maintenance, but that's kind of all they can do.
It's a similar problem that we're seeing over here. The windfall tax story front and center in many European countries. The UK has already imposed one. And the refinery issue is a really important one here, Alex, because none of us use barrels of oil. We all use refined products. And you can go to the Saudis, you can go to OPEC, you can talk to the oil industry, tell them to pump more. But even if they pump more, you've got to have the refineries to process that capacity. And that's where we need help. But as you say, building a refinery is a really long-term project.
Yeah.
And ain't going to be around for very long, potentially.
And this is where I think you can make the argument that this kind of inflationary pressure can't be transitory unless demand just kind of totally falls out of bed for that exact reason. Yep. I don't know how you make a case as a government official to the oil industry to do more when your long-term goal is for them to not produce their products that you want them to produce now. I don't know how you do that. I think that is an extraordinarily confusing message. How do you create a policy that makes sense with that when you're trying to convert? A lot of these refineries are now doing biofuels rather than gasoline because of mandates and because of where the industry is headed. That's a really tough situation. I do not know how you solve that. Yeah. Policy mistake. We seem to be hearing a lot about those right now. And maybe this is one of those. I just want to flag something else as well, which is just happening in the energy space. You guys are dealing with gasoline over there. We're dealing with nat gas over here. Gazprom earlier on halting one more compressor, basically squeezing flows into Europe. Germany's economy minister, Mr. Habeck, just talking about this, saying that Russia is trying to unsettle the energy market, drive up gas prices. You've seen a spike higher in gas prices. That just raises another problem for the ECB on the inflation front, which is its biggest priority now, fragmentation or fighting inflation. I don't think we still know the answer to that question, but it does take us back to what is happening with the central bank story. We're waiting for the Fed. 75 basis points looks like the base case. Could get 100, could get 50. Catherine Rooney-Vera, Baltic Capital Markets CIO, joining us now to give us her take on this. Catherine, what do you think is priced for later? What do you think moves markets?
I think if the Fed doesn't do 75, markets move to the downside because it will be a complete jolt to what is left of Federal Reserve credibility with regard to inflation fighting. There's been innumerable mistakes made by the Federal Reserve, of course, starting with inflation is transitory. There is no wage price spiral. The labor market needs continued support. Remember that the Fed was still buying bonds up and through March of this year. What we're not talking about beyond rates, though, is quantitative tightening. And supposedly that's going to start this month, too, to the tune of some $46 billion, with the intention of that moving to $95 billion. The economy is not in a position to withstand that double-barreled approach. So I think there's a lot of potential, and this is something I said, Alex, going into this year. The biggest risk this year was Federal Reserve policy mistakes, and I think there have been many.
Catherine, how then do you manage the risk around this Fed meeting?
Well, I think what we've been telling our clients is to be defensively positioned in defensive sectors, and those have been by far the best performing ones year to date, and those are energy, utilities, staples, and healthcare. We've been calling stagflation as the main base case scenario for this year, and that seems to have been unfolding. And what we're saying, going forward is be diversified, be looking into alternatives, because the correlation in the 60-40 portfolio, we all know doesn't work anymore. It's completely broken down. You have everything falling out of bed together. But what I'm most concerned about is what happens when we get that recession? What does the Fed do with its balance sheet? Does it go back into quantitative easing? Are we going to be whipsawed by Federal Reserve policy? And for that, I'll bring up something that no one has really been talking about, Alex, and that's the threat to a crisis of confidence in fiat money. You know, we need to unravel this ultra accommodative expansionary policy that we've seen for the past decade. And if we don't do it and yet get into a recession and have to revert back to the bad old ways of additional bond purchases and ETF purchases, then I think it just degrades and debases even further, not just monetary policy credibility, but the pure value of fiat currency.
Catherine, in that kind of environment, actually in this kind of environment, in the environment we're in right now, we may get to that ultimately. You laid out a series of areas that you're focusing on. Is putting money to work in those areas enough at this point to avoid losing money? That appears to be the question right now. Not how do I make money, how do I not lose money?
How do I not lose money is the question that we're getting a lot. Yes. And I think that having a cash position is a really wise move. Making that rotation and taking some profits in your winners, I don't think is a bad idea. Moving into, if you're a dedicated equity investor, moving into the defensive sectors I enumerated, but also adding to your precious metals position, because if I'm right, we get additional policy mistakes, both from the fiscal and monetary side, then I think precious metals do very well over the long term. So let's start to accumulate those. Let's diversify. Let's get into, KKR put out a very good piece, which I thought was good. It enumerated different asset classes that can preserve your wealth. And those can be something like private credit, infrastructure, real estate, just diversified beyond what is historically public markets that have been really blown up by manipulative monetary policy, and something that ultimately has to unwind. So I would probably move increasingly into real assets and alternatives, including precious metals.
Catherine, I guess let me ask the same question in a different way. So that's like not how to lose money, but how do you then make money? And that, are there certain sectors that have priced in recessionary fears enough that now you need to start looking?
Yeah, I guess you're referring to technology, communication services, and discretionary, because those have been walloped. I think there's still further to go, because if the Fed does in fact jack up rates to the tune of 4%, which is in many cases the market is priced in the terminal rate, but if inflation expectations continue to move higher, which they are, and the Fed is unable, Alix, to control inflation, and therefore they have to do even more, I would say that that tech, discretionary, and comm services have further downside to go. Of course, there's always going to be tactical plays. And for that, I wouldn't recommend sectors. In fact, the house view at Baltic is to look at specific names. Do your research, look at the fundamentally strong names, but maybe not go whole hog into ETFs or the S&P 500. I think we're going to have to be selective, and I think there's a lot of risk to digest going forward, not just from monetary policy and the bubble that we've seen in the equity and fixed income markets, but also from the economic perspective. I'll just say one more real quick thing. What I'm really looking for is real wages. When do they turn positive? Do they turn positive? Because that would be a plus. That would be a positive for consumer sentiment, and that could ultimately make that precipitous drop that we've seen in consumer sentiment finally reach a bottom and possibly turn a corner. So watch for real wages.
Is it possible, even at a granular level, at a single stock level, to get a handle on ultimately where we kind of go next if we don't know where the Fed, how aggressive the Fed is going to have to be here, Catherine?
Yeah, that's why I would say, be more defensive. But for guys that want to play tactically, that would be my recommendation. Look at specific names. For people that, like me, we don't, know what's going to happen, but we have a good idea of where things could go and the worst case scenario, right? The worst case scenario being, of course, recession and high inflation, which is stagflation. So under that scenario, I do think that you want to have a nice cash position. I do think you want to have so alternative exposure. You want to have real assets. You want to have real estate. You want to have a gold. And I think this is what makes sense at this point. I don't think we need to be trying to time the market, because that's historically impossible to do. Guys can say that they can do it, but the fact is they can't. So I think we just need to be very careful and be defensively positioned.
Catherine, it's really great to see you. Thank you so much for joining us. Catherine Rooney-Vera of Baltic Capital Markets. Good to see you. All right, coming up, the bear market for Bitcoin has definitely entered its so-called deepest and darkest phase. We're going to get more from Michael Sonnenschein, Grayscale Investments CEO, coming up next. This is Bloomberg.
This is Bloomberg Markets. I'm Rishika Gupta. You're looking at a live shot of the principal room. Coming up, Bill Dudley, the former New York Fed president, joining Bloomberg Television, 3:30 p.m. at New York time. Don't miss it. This is Bloomberg. Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. French President Emmanuel Macron says the lines of communication to the Kremlin have to stay open. Speaking during a visit to a military base in Romania, the French leader said fresh discussions between Ukraine and the European Union were needed to send a, quote, signal of support in a critical moment. His comments came after he caused an uproar by saying that the allies shouldn't, quote, humiliate Moscow and risk a peaceful solution. A vague tweet today by the founder of Three Arrows Capital, an influential hedge fund that has been liquidating crypto holdings as prices plummeted, is creating new apprehension in the industry. Former Credit Suisse group trader Su Zhu tweeted his group was, quote, fully committed to working this out. Without providing further details, there's been no further comment from Zhu. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. Appreciate that. So let's stay with Bitcoin for a second. The bear market for Bitcoin has entered its deepest, darkest phase, and that's according to some strategists over at Glassnode. They kind of track the fair value of Bitcoin, which they estimate is about $1,000 lower than what it's trading at. So let's get more on the overall market. Michael Sonnenschein, Grayscale Investments CEO. Grayscale is the world's largest crypto fund. And Michael, thank you for joining us. And I just want to start on that 3 Arrows Capital tweet because they're the biggest investor in Grayscale Investments. And I want to, can you tell me about it? Like, what are they liquidating? What's happening?
Yeah, so first of all, great to be here and happy to chat with you guys as always. What I can share about 3 Arrows Capital is that they are in fact a client. Of course, consistent with company policy, I have to direct you to the publicly available information around 3 Arrows. They did, of course, disclose that they do hold shares of Grayscale Bitcoin Trust, but I believe that is about 1.5 years, if not longer, ago that it was originally filed.
Can you talk to me about what you are seeing in the market right now, Michael? What is the picture? We've obviously seen some significant price action to the downside over the last few days. What are you hearing? You've got your ear to the ground.
Indeed. Well, there is certainly volatility in this market, but I think to really examine what's going on with crypto, we really have to think about it in the context of the broader market. Over the last few months, we've certainly seen a lot of volatility across asset classes, beginning with the fact that you've, of course, seen rising rates in the US, you've seen inflation, and as a result of that, you've seen turbulence across pretty much every single asset class. There's really not anything that in particular could kind of shelter itself from that volatility. In crypto, we have seen increased selling pressure on prices recently, and some of that is certainly due to recent events such as the Terra event we experienced a few weeks ago, and now seeing some other individuals and other businesses that perhaps had too much leverage in this ecosystem beginning to unwind some of those positions, which is leading to adding selling pressure in crypto.
So I know that people are going to say that crypto's weathered a crypto winter before, that you guys have done this, it's okay, like it's okay as an asset class. But my problem is what's different now is that the era of easy money is over. That is 100% going to be over. And that is different. And there's so many more products now in the crypto market. And I'm wondering where the liquidation systemic risk may lie.
I think it actually speaks more to opportunity within the crypto ecosystem, Alex. I think if you're seeing players that did not have the proper governance in place or were employing too much leverage, ultimately getting flushed out of the ecosystem, as those other players that remain continue to weather a crypto winter, that are continuing to build, that are continuing to add to the application layers, that are continuing to add to the real world use cases, you are going to see a variety of winners coming out of this crypto winter. And I think certainly for an investor perspective, they're really thinking hard and fast about who their counterparties are and what types of applications and protocols are important to have in their portfolios in this kind of environment.
One of the use cases for crypto has long been touted as being a store of value, Michael. Is crypto still a store of value?
I think over a longer term horizon that Bitcoin in particular has demonstrated that it has the properties of a store of value or of a digital gold, and that over a shorter term period, which we've seen recently, it has faced criticism that it is in fact not acting in that regard. I do believe over a longer term time horizon, we have and will continue to see investors flock to assets like Bitcoin as a store of value, as an inflation hedge, and particularly in turbulent markets or when they typically have gone to assets like gold and bonds and other stores of value. I do think that Bitcoin can act in that capacity in their portfolios.
So that's a bit different, though, than like the crypto lending market and margin and such, which is some of the areas of crypto that have gotten hit really hard have to do with margin lending. And I'm wondering how you see the lending environment right now as it relates to crypto, and also how it relates to Grayscale.
Well, Grayscale, I think certainly, and what we've been hearing from our investors over the past few days is actually a really strong appreciation for the way that we run our investment products. We don't employ any leverage. We do not have any type of lending out of any of the underlying assets. Instead, when investors put capital to work in a Grayscale product, it is invested one for one in that underlying token. I do think that as you're looking at the crypto lenders that are out there, some of them have perhaps employed too much leverage. And of course, as prices have become suppressed, they will, of course, have to face margin calls.
Mike Novogratz compared what's happening now to LTCM in 1998. Michael, what do you think of that?
I think that that's probably too early to make that kind of analogy. I think crypto continues to face all kinds of criticism, and there will continue to be comparisons to the dot-com bubble or to the meltdown of LTCM or others. But ultimately, crypto is here to stay, and there is no question about it. I think you're seeing a lot more attention being paid to it from the regulatory community, which really will add to the asset class's staying power.
Well, I was going to say, yes, crypto will stay, but in what form will it stay in? And when we see these kind of intense price moves with this volatility, when regular people lose a lot of money, then comes the regulators, and then they put regulation on it, and then it changes what it becomes. What kind of regulation can we realistically expect?
Well, now you're seeing bipartisan support in D.C. There was a recent bill introduced from Senators Gillibrand and Lummis that actually puts forward new rules and regulations and establishes authority over crypto commodities. I think that these are the beginnings of conversations that are long overdue in Washington. On the heels of the White House executive order that really is calling into action all of the federal agencies and asking them to ensure that they're paying attention to this, and that as a country that we stay competitive and that we are fostering innovation, it really is time for the U.S. regulatory community to step up to the plate and ensure that these types of products and these types of businesses aren't moving outside of the U.S. because there aren't enough rules and regulations to govern how those businesses should operate.
Michael, thanks for stopping by. Really appreciate the time. Michael Sonnenschein, Grayscale Investments CEO. Thank you very much. This is Bloomberg. 35 minutes to the European close. Let's talk about the price action on this side of the Atlantic. Stocks are up. They're not very interesting, though. The real interest is over here. BTP's really reacting massively. Went through 4%. ECB comes out, announces an emergency meeting. BTP's absolutely catch a massive bid. Yields come down. We're moving by 37 basis points right now. The other story is we get another compressor turned off by Gazprom. Gas flows into Europe are getting squeezed. The Germans are worried. That's Dutch gas front months, 23% to the upside. Lots of volatility there. Antoine Beauvais, ING Senior Rate Strategist, joining us next. This is Bloomberg.